Hi everyone, how are you all? Just confirm me if audio, video, and the screen is visible to you guys. Good to go? Yes or no? Okay, wonderful. So in the last class, we have started with the BRS. BRS, we have almost completed the part which you need to do someone in homework. So what were the queries you came across in the last class? Were there any doubts? Come on, everyone. We have solved around 2 to 3 questions and many examples which we did in the last class. But now we have to more focus on the other part of the chapter, which is your accounts receivable reconciliation. Yeah. And accounts payable reconciliation. So are we ready for that part? Okay, great. So now coming to one of the most important part, that is the receivable reconciliation and the payable reconciliation. 1 second, I will just reshare the. Can you confirm that screen is visible now, everyone? Okay, so we are on the receivable reconciliation part. What do you mean by the receivable? Receivable means you need to get some money from a customer. Let us first understand the background about the reconciliation of receivables. So what is receivable? By general terms, what we can understand, receivable is nothing but it is an asset for us because that money will be received in our bank account. Okay, that is the first and the foremost thing, in our bank or in the form of cash. Okay, that amount is receivable. So obviously, who is going to pay us the money? Those person who has purchased some goods as services from us. So what our business has done. For example, our business name is A Enterprises. What A Enterprises need to do so that there would be receivable from these persons. So obviously, in return, there would be some sales. What would be there? There would be some sales for which the amount is due from these three person to the A enterprises. Now, these three person, for example, this is Mr. X, Mr. Y, and Mr. Z. Our books of accounts means what? A enterprises. A enterprises says that I have sold 1,000 rupees goods to Mr. X. How much? 1,000 rupees goods to Mr. X. Let's say 1,500 rupees goods to Mr. Y and 2,000 rupees goods to Mr. Z. So what is the total amount which is receivable from X, Y, and Z? What is the total amount? So from X, we have 1000, from Y, it is 1500, and from Z, it is 2000. That would sum up to 4500. So 4500 is the receivable amount in the books of A Enterprises. Now, after 1 month, I am going to Mr. X shop, Mr. Y shop, and Mr. Z shop, asking for the money which is due to them respectively. So if I went to Mr. X shop, I went to first Mr. X shop. From whom how much money I should get? I should get 1000 rupees. 1000 rupees I should get from Mr. X. Mr. X told me that I have just need to pay 800 rupees. That 800 rupees is due. So what is the difference amount now? In my books, I need to take 1000 from Mr. X, and X is saying that only 800 is due. So what is the difference between the two? So difference is rupees 200. Difference is rupees 200. So now I have to investigate that from where this 200 difference is arising. So basically what I am doing nothing but the reconciliation of my receivables. So if I say what is receivable, that amount which we need to receive. If I say if reconciliation of payable is done, so the amount which is our liability that we need to verify. So in this case, Mr. X need to pay to A Enterprises. Mr. X needs to pay to A Enterprises. So for A Enterprises, it is a receivable, but for Mr. X, it is a payable. Obviously, if one person need to receive, so other needs to pay that amount. So if I am doing the reconciliation for Mr. X, I will call it as reconciliation of payables, and here I would say reconciliation of receivables. So that is one in the same thing. From the debtor aspect, it is receivable. From the creditor aspect, it is payable. Am I clear, everyone? Any doubt in this? So this was the basic theoretical part of, or I would say the background of the reconciliation. Now what we will do, we will go to the questions and understand how we can reconcile these balances. But just before going to this question, I was saying that I went to Mr. X shop. I went to Mr. X shop to take 1000 rupees. Mr. X said only 800 rupees is due. So I got the difference. I got the difference of 200. So Mr. X told me that 200 was agreed as trade discount. It was agreed as a trade discount. So in my books, it is not updated yet. In my books, it is not updated yet, but X knows he needs to pay only 800. So now what I have to do, I have to update my receivable figure from 1000 rupees minus 200. Now the net receivable would be rupees 800. So that's how we will do the reconciliation of receivable. But this is the very easiest part. I would say the bank reconciliation was more difficult than the receivables reconciliation. So going to the notes, if you go to page number 174, you can see that a business enterprise, apart from the cash sales, also provide or offers credit to its customer. During the number of transactions taking place on a daily basis, there is a need to reconcile the balance receivable from the customer or the debtors. What is the process of the reconciliation? So from the step number 1, we will find out what is the total credit sales to the customer. It may be the case that to Mr. X, I have sold on 1st of April, then 5th of April, then 9th of April, and then 15th of April. There would be several instances of our sale. We will check that what is the total credit sale to that particular customer. Then step number 2, ascertain the total collections in cash, check or any other mode it was received. So if Mr. X has paid me on 4th of April and 10th of April, so that is the collections which I have received from Mr. X that will be deducted from the total credit because that money is already paid by Mr. X. So I need to find out what the balance amount which is due. So step number 3 is identify whether there are any bills receivable accepted by the customer. So bills receivable, as we discussed, it is a legal document where the customer says that I will pay you after 1 month or 2 month or 3 month, whatever it is written over there. So if they have accepted the bills receivable, so we need to identify that. Step number 4, identify any check return. For example, on 4th of April, he gave me a check of 10,000 rupees. However, the bank rejected that check. That means the check is bounced. So in that case, I have to again ask Mr. X to pay that money because I have not received the funds as the check is bounced. We need to check if there is any goods return. We need to check if there are any bills which are dishonored. Bills are the same thing, bills receivable. So if the customer has said that I will pay you after 3 months, but he does not pay, so that would turn to bill being dishonored. Okay, during the accounting period. So that's all consideration which we need to take for this. Last step is check whether any credit note is raised against the customer for short supply of goods or excess payment or allowing a special discount. So step number 5, for discount, I've already asked that I have given him a discount of rupees 200, which I've forgotten, but obviously Mr. X will not forget that. So I will deduct that amount from my total receivable. In the same case, if there is any special discount or if by mistake X X has to pay you 1,000 rupees, but by mistake he has paid you 1,100 rupees. So you have received 100 rupees extra. Now he purchased goods of 500 rupees from you. Now obviously he will adjust this 100 rupees and will pay you only 400, not 500. He will pay you only 400. So that is any excess payment which you have received. Or we can say that he purchased the goods of 1,000 rupees, but by mistake I gave him the goods of rupees only 800, not 1,000 rupees in actual. So that is called short supply of goods. That is called short supply of goods. So for short supply of goods, obviously I will not take money from the customer because I have not given him the goods only. Okay. So we have one illustration given over here, illustration number 14. Mr. B sold the goods on credit to various customers. Detail of one of the customer, that is Mr. Z, is given as under. First point, the goods were sold on credit for rupees 5 lakh. Then goods returned by customer rupees 30,000 due to defective quality and credit note was raised but not recorded. There was a credit note which was issued to the customer, but it was not recorded. So in my books, my balance would be showing to customer as 5 lakh. But for 30,000, we have issued the credit note, but not recorded. So if I go to Mr. X house right now, whether he will pay me 5 lakh rupees? Come on, everyone. Tell me whether he will pay me 5 lakh rupees. The answer is no. Very good. Why no? Because obviously the goods of 30,000 were defective. So actually I got the goods of rupees 4,70,000 only. So Mr. X has not paid me
X will be only liable to pay the balance amount of 4,70,000. Okay. Now moving on. Payment received from customer in cash rupees 1 lakh and by check 2,30,000. Out of the check received, a check of 38,000 was dishonored by the bank. So till now, I need to take 4,70,000. Now they are saying that he has paid minus 1 lakh rupees in cash, minus 2,30,000 in check. So whatever is the balance due, let's say it is 1,48,000 is the balance due after deducting 3,30,000 from it, which is paid by check or cash. Now they are saying 1,40,000 is due, but 38,000 was dishonored by the bank. Now I will take it back from the customer. So I'm adding it into his receivable account. So it would be 1,78,000, which I now need to take from Mr. Z. Okay. Then we have one more line. Customer accepted two bills of 19,000 and 56,000 for 2 months and 3 months respectively. So that is the bills receivable. I will deduct the bills receivable because he has accepted that. It is of 19,000 and 56,000. So these both are also deducted from the total balance of 1,78,000. Okay. And at last, credit note credit note raised against the customer of 3,400 for excess payment charged against one of the consignment. So how much we have extra charge, that is 3,400. So we need to deduct that from our receivable balance. So after deducting these all, whatever figure will come, that would be the reconciliation of your receivable. What is the figure? 1,78,000 minus 19,000 minus 56,000 and 3,400. So it would be 99,600 rupees, which I yet need to receive from Mr. Z. Okay. Now here, let's look to the adjustment. So they have recorded a sales of 5 lakhs. Goods returned by a customer 30,000 has been deducted. The payments which have been received in cash 1 lakh has been deducted. So total money in check was 2,30,000 and 38,000 was dishonored. So net amount of 1,92,000 has been deducted. Then we have a receivables of 19,000 and oh, the amount is written incorrect. This is not 56,000. This is 53,000. No, 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 no. In question, it is given 56,000 and here they have only considered 53,000. So correct in your books this amount. This is 56,000. So it would be not 72 over here. It would be 75,000. Please correct this in your books. Okay. So you need to deduct those bills by 75,000. And at last, the credit note which was raised, it is 3,400, which will turn your balance to be 99,600. You need to correct this balance as well. There is an incorrect answer which is given in your books. Please correct that. There is a misprint of 56,000. It should be, sorry, there is a misprint of 53,000. It should be 56,000. Okay. Any doubt in this? That was a very, very simple question on the receivable reconciliation. Any doubt? Okay, moving on to the payable reconciliation. Whatever we have done in the receivable, same cut, copy, paste in the payable reconciliation, nothing new. What we need to do here, we need to look for the credit purchases, total credit purchases from different vendors or suppliers. Then what are the payments made to them in cash, check, or any other mode? And then we have to identify whether any bills payable is accepted against them. Likewise, we have done in the receivable part. Then we need to identify if there is any purchase return, goods return, bills payable accepted but dishonored during the period. And at last, whether any debit note is raised against the vendor or supplier for short supply of goods or for excess payment or claiming the special discount. So all the same points which were covered in your receivables reconciliation are now repeating in your payable reconciliation. If you have your notes with you, there is illustration number 15, which obviously you can do by yourself. It is your homework. It is same as what we did for the payable reconciliation. Try to do this by yourself. And with this, we will be finishing off with your chapter, that is reconciliation statements. That is reconciliation statements. Okay, this has been covered your BRS, reconciliation of receivables, as well as reconciliation of payments. Okay, I have received one question, one doubt regarding the bank reconciliation. That is a very big doubt, I would say. Let us address that. So what the student is asking, that cash balance is showing to be rupees 3,000. So there is a cash balance of 3,000 on 31st of December 2012, and checks have been issued for check issued rupees 2,500. Okay, out of which check worth rupees 2,000 were presented for payment. Okay. Then check worth rupees 700 were paid on 20th December but had not been cancelled by the bank. So these are all separate checks, or it is a same transaction beta? You need to clarify this. Your question is quite unclear. So I will take both the cases, whatever the case you have given, that case and other one also. So if the question is saying the check issued were 2,500 and out of which only 2,000 were presented for payment, so that means 500 is not yet presented. 500 is not yet presented. But obviously, if I have issued that, I would have deducted from the cash books. So if I need to go to my passbook, I will add 500 rupees to the cash book balance in the name of check issued but not presented. So my passbook balance will be 3,500. That was your first part which you asked for. Okay, that was the first part which you asked for. My passbook balance would be 3,500. Okay, then it is mentioned that check worth rupees 700 were paid on 20th of December but not yet cancelled by the bank. One check of rupees 250 entered in the cash book on 30th of December but was banked on 3rd January. So beta, these are all the general doubts which you are sending me relating to the question. I think these are all separate points, not one particular thing. Okay. do one thing, send me a snapshot of your question and then we can take it over, because here your comments are not quite clear. This is whole paragraph which I need to read, and there is no full stop, commas, or what point they are referring to. Okay, so just take a snip of your question and send it over. Yeah. Okay, guys. So that was all for your reconciliation statements. Now we are going to start with a very new chapter called Accounting for Depreciation. One second, I will just share back my screen. I think it is not visible to all. Please confirm me if everyone is able to see the screen now.
Is it visible now? I think this should be clear. Okay, thank you. Thanks for confirming. Okay, so we were starting a new chapter called Accounting for Depreciation. So before starting the chapter, let us understand why depreciation is being calculated and why depreciation is a requirement of accounting. Okay, so that is our basic aim to understand the overview of depreciation, because if you understood the overview, everything will be very clear to all of you, that how depreciation is charged, when depreciation is charged, and what is the logic behind charging the depreciation in the books of accounts. Okay, so without wasting any time, let us start with this wonderful topic, which is called depreciation. So let's assume you have purchased one machinery. Let's assume you have purchased one machinery, and that machinery has a life of 5 years. How much life we have? We have a life of 5 years in that machinery. Now, how can you identify whether that machinery is a cost to production or it is an asset? Everyone, tell me that. How can you identify that the machinery is an expense or it is an asset for you guys? I think again there is an issue with the screen. 1 second. We'll share it back. Actually, there is some problem with connecting to the iPad. I will just take you over to another screen on my laptop itself. Okay. Now please confirm if this screen, the Excel file is visible to you. Okay. Now, if I purchased one machinery, it cost me rupees 50,000. Machine cost is how much? It is 50,000. Now, I can't see the visual. Is it visible to others, beta? Yes, is it visible? Okay, great. So I have a machine whose value is 50,000 rupees and the useful life is, let's say, 5 years. Its life is how much? 5 years. Now, if I say, everybody has answered me correctly that if I purchase this machinery, this is an asset for us. But do you think that after 5 years, this machine will have no value to me? It will be a zero value. If I try to sell this machine in scrap, I will get 0 rupees. So what is the scrap value of this machine after 5 years? So after 5 years, this machine will be of how much? Only 0 rupees. So do you think that this machine, who was an asset for me earlier, now will become of 0 value? So can I book it as expense? For example, what I will do, I will debit the profit and loss account. I will debit the profit and loss account debited with how much? With 50,000 rupees to machinery account. To machinery account, 50,000 rupees. So do you think this is a correct picture? Correct picture means what, sir? This 50,000 is now booked as a loss in my profit and loss account, because earlier I purchased it for 50,000. Now it has no value, that is means it is of 0 rupees. So whole 50,000 I have paid for this machine is lost. Okay, whole 50,000 is lost. That means what, beta? What does it mean? That means I am charging full cost of machine in the year in which it is scrap. What I am doing, I am charging the full cost of machine in the year in which it is scrapped. So there was an argument which said that this machine is used for whole 5 years, then why are you charging whole 50,000 in 1 year only? For example, this machine was purchased in 2021, then used in 2021, 2022, 2023, 2024, and 2025. So in the first year, I booked this as an asset, and here I am booking this as a loss of rupees 50,000. So this loss is of 1 year, or this is for the whole 5 years. Obviously, this machine is not a loss. This is an investment. What is it? Better, this is an investment. But this investment will be used in the production process on a daily basis. And because of being used in the production process, its value will diminish over a period of time. What will happen? Its value will diminish over a period of time. Why it will diminish? Because there would be normal wear and tear, accidental damages to this machine. Okay. There could be obsolescence. What is obsolescence? That this machine will become obsolete. There would be a new version of machine which would be available after 5 years. For example, today, if I have an iPhone which is 13, after 5 years, there would be iPhone 18 or 19 which would be in the market, right? So this iPhone version will become obsolete at that point of
time. It will become obsolete at that point of time. So obviously, whenever I use any asset, every year the depreciation should be charged to it. That is called depreciation, which is caused because of normal wear and tear, accidental damages, and the obsolescence. So if I say, would it be logical to bifurcate this 50,000 into all the years in which I use this machine? So it would be year 1, year 2, year 3, year 4, and year 5. So in all these 5 years, what I will do? I will credit machinery account. I will credit what? Machinery account by 10,000. So sir, if you credit the machinery account, the value of machine will reduce. Yes, beta. So what will be the value of machine after 1 year? That would be 50,000 minus 10,000. The value would be 40,000 only. That is called WDV. That is called WB. That is written down value. It is written down value. That means we have charged the depreciation and now 40,000 worth rupees machine is left because on the first year 10,000 is being used already. Now in the second year we will use another 10,000. Now the WDV will be 30,000. In the third year again it would be 20,000. Fourth year it would be 10,000, and in the fifth year it will be of zero value. Why zero value? Because after 5 years, the scrap value of the machine was how much? It was given in the question. What was the scrap value of the machine after 5 years? It is 0. So we have what we have done. We have charged the depreciation. We have charged the depreciation. That means we have credited the machinery account by 10,000 and we will be debiting the, we have debited the depreciation account by 10,000 every year. So that means what is depreciation? It is a charge to P&L. It is a depreciation is a charge to profit and loss account. That means it is a expense for you. That means it is an expense for you. What this expense relates to? It relates to systematic allocation of cost of an asset over its useful life. Systematic allocation of cost of an asset over its useful life. That is what depreciation is all about. Depreciation is a charge to P&L. It is an expense, therefore it will be debited. So when we will debit the expense, that is, we will debit the depreciation. What we will credit? We will credit the machinery account. That is, we can say we can credit the asset account. And why this will be credited? Because its value will be falling over a period of time. OK, so if I ask you, is there any asset to which depreciation is not charged? What that asset could be? Is there any asset to which depreciation is not charged? What that asset would be? Can anybody answer that? What would be that asset to whom the depreciation will not be charged, whose value will not reduce? So the correct answer to this question would be land. In India, the land value keeps on increasing in maximum cases. In most of the cases, I would say. There could be some case where the land becomes unfertile or not good enough. That way the value can reduce, but in all other cases, it's keep on increasing. Therefore, there is no need to charge depreciation on land. There is no need to charge the depreciation on land. What about building? So if I say the building over a period of time, it will become old. Its value will decrease. So depreciation can be charged. So if I can say that depreciation can be charged to the building. So in a nutshell, if I can say that depreciation is charged to depreciable assets only. Depreciation is charged to depreciable asset only. That could be your machinery, furniture, plant, etc. Okay. So what is depreciable asset? What is depreciable asset now? Those asset which has a useful life, or I would say a limited useful life. Okay. Because if the asset does not have any useful life, it can be used for infinite years. So why we are depreciating it? Right? So that is the foremost requirement, that the asset should be a depreciable asset. Okay. Second condition, that the asset is used for generating income or profit. Okay. First, useful life. Useful life should be greater than 1 year. It should be greater than 1 year, because if it is less than 1 year, there is no need to charge a depreciation. You can directly book it as an expense in your profit and loss account. But if it is for more than 1 year, then you need to charge year by year. So useful life should be limited and greater than 1 year, and the asset should be used in generating income or profit. That means it is used for the production purposes. Okay, so that is the definition of asset. Production includes your rendering of service. So that is what depreciable asset talks about. Now, if I come to the first method of depreciation. So basically in your course, there are two methods of depreciation. First is called straight line method of depreciation, which is also called the SLM method. And the other one is called written down value method. WDV method. The first one is SLM. Another one is written down value method. If I talk about the first method, that is SLM method, what does that method says? Let us go to that method. Okay, some students have answered me correctly. Line, that is good, very good. Okay, what does straight line value method says? That there is a formula for calculating depreciation per annum. Per annum means per year. So the formula is your cost of the asset minus the scrap value, whole thing divided by the useful life of the asset. Whole thing divided by the useful life of the asset. So what is the formula? Cost of the asset minus the scrap value of the asset divided by the useful life of the asset. That is the formula. Now, if I give you one example, can you calculate the depreciation for this asset? Mr. X purchased furniture worth rupees 90,000. Useful life of which would be 4 years. Scrap value is also called the residual value. After 4 years would be rupees 10,000. Scrap value after 4 years would be rupees 10,000. Calculate the depreciation per annum as per straight line method. Everybody, this is the formula. This is the question. Come on, give me the answer. What is the depreciation per annum as per the straight line method? It is very simple to calculate this. Everyone. So simply you have to apply your formula. That is, what is the cost of the asset? Sir, the cost of the asset would be 90,000. What is the scrap value? I need to deduct the scrap value. So minus 10,000. Okay. And then what is the useful life of the asset? So the useful life of the asset is 4 years. So 90,000 minus 10,000 is 80,000. That would be divided by 4. 80,000 divided by 4. Come on, everyone. What is the answer? That would be 20 rupees. 20,000 per annum. It would be 20,000 rupees per annum. That's the answer you got. Very good. Amazing. So that is the depreciation amount per annum. Now let's see what will happen to this asset. This asset was of 90,000 rupees. Okay. So it is of 90,000 rupees. In the first year, I will charge the depreciation of 20,000. So what is the value left? What is the value left? So this is the year 1. This is the first year. Year 1. Can I say this is the opening value? Then we have the depreciation. And then we have the value left. So after the first year, the value left is 70,000. So the opening for the second year would be 70,000. Again, depreciation 20,000. And what will be the value now? It will be 50,000. In the third year, opening value would be obviously the closing of previous. Then the depreciation of 20,000. Value left will be 30,000. And in the fourth year, the 30,000 will be the opening. The depreciation will be 20,000. And at last, the value will be remaining as 10,000. So in the previous example, the value was 0. Here we have 10,000 as the value. So beta, you can see that the scrap value after 4 years is 10,000. So whenever if I sell this machine, sell this furniture, then what I will do? I will debit the cash or bank account by the amount which is received. Let's say if I have got only 10,000 rupees, so cash and bank account will be debited to machinery account. That would be again 10,000. And your machine will be out of the books. Okay, this is how we do the accounting treatment. Obviously, I have not told you the journal entry, but I have tell you the normal concepts which are relevant for these. In the next class, we are going to discuss more in detail the depreciation account, the journal entry, which will be taken care in this chapter. This was just an overview and the basic idea of what depreciation is all about. Okay. So everyone, thank you so much. And in the next class, we are going to cover up the later part, which is the main depreciation calculation and as well as the other method of your depreciation. Okay, so don't miss the next class. Thank you, everyone. Bye. Take care.